Digital nature versus physical form. Cryptocurrencies exist solely in digital form, meaning they have no physical counterparts like coins or banknotes. Traditional currencies, such as dollars or euros, are tangible and can be physically exchanged. Cryptocurrencies are purely electronic and rely on technology for transactions and storage. Centralization versus decentralization. Traditional currencies are issued and regulated by central banks or governments, making them centralized. Cryptocurrencies, on the other hand, operate on decentralized networks, typically using blockchain technology. This decentralization removes the need for an intermediary, such as a bank, to facilitate transactions. Regulation and control. Traditional currencies are heavily regulated by governmental institutions and central banks. These authorities control monetary policies, such as interest rates and money supply. Cryptocurrencies, in contrast, are not controlled by any central authority, and their value is determined by market forces, making them more volatile. Transaction speed and fees. Cryptocurrency transactions can be processed much faster than traditional currency transactions, especially in cross-border payments. Traditional financial systems, such as banks, may take several days to process international transfers. Additionally, cryptocurrency transactions often have lower fees, while traditional banking systems can incur higher transaction fees. Anonymity and transparency. Cryptocurrency transactions can be pseudonymous, meaning the identities of the parties involved are not always revealed. However, all transactions are publicly recorded on the blockchain, offering a high degree of transparency. Traditional currencies, especially in digital forms like credit cards, are more easily traced to individuals through banks and payment providers. Inflation resistance. Cryptocurrencies, particularly Bitcoin, are often considered a hedge against inflation because their supply is limited by algorithms. For example, Bitcoin's maximum supply is capped at 21 million coins. In contrast, traditional currencies can be printed or minted by governments, potentially leading to inflation if too much money is created. Global accessibility. Cryptocurrencies provide a way for individuals to access financial services without relying on a traditional bank. This makes them accessible to people in regions where banking infrastructure is limited or non-existent. Traditional currencies, however, are often restricted by national borders and require formal financial institutions for transactions. Market volatility. Cryptocurrencies tend to be much more volatile compared to traditional currencies. Their prices can experience rapid and significant fluctuations due to factors like market sentiment, regulatory news, or technological changes. Traditional currencies, though not immune to fluctuations, typically have more stability due to the backing of central banks and government policies. Ownership and control. In cryptocurrency systems, individuals have full ownership and control of their digital assets through private keys. There's no reliance on third-party institutions for storing or transferring assets. On the other hand, traditional currencies stored in banks are subject to banking hours, fees, and restrictions, and the bank holds the power to freeze or limit access to accounts. Investment and speculation. While both cryptocurrencies and traditional currencies can be used as a store of value, cryptocurrencies are often viewed as speculative investments due to their volatility and potential for high returns, or losses. Traditional currencies are less speculative and are primarily used as mediums for exchange and stores of value in everyday transactions.